It was a great day for bulls on Wall Street as we saw the S&P 500 close higher by 1.9%. Not only that, but we basically closed at the highs of the session across all major U.S. equity indices. Specifically within the S&P 500, we saw that 87% of its components closed in the green today. So it was a broad-based rally, not just the leaders, not just the generals, even the foot soldiers came along for the ride. Really, the only sector that sat out today's rally was energy, of course, which has been red hot this entire year, so it deserved a little bit of a breather here today. A lot of what led to today's rally was probably related to Microsoft, as it was down significantly in the pre-market session and then came rallying all the way back to close in the green by the time it was all said and done. So we'll take a look at all that information, see what it means for our posture moving forward, and then we're going to get into our trade application example where I wanted to feature a retail internet related name that is still trading on the underside of its falling 30-day moving average, and see if we can sprinkle in a nice bearish trade here or there as the market is advancing higher. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 2nd, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list. That way you can be notified whenever we post these videos. You'll also be alerted to what stocks are giving you overbought or oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. If you're not doing so already, I would encourage you to follow me, and we really appreciate those of you that click like and retweet on these Market Outlook posts along the way. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo there in front of you. All right, let's go ahead and jump into today's trade activity. And my oh my, it was another nice win for the bulls. As you can see, I've got the S&P 500 heat map pulled up here in front of us, and we have a lot of green, an ocean of green. This was a day where both the generals and the foot soldiers were all advancing in the same direction together. So it was good to see that, a good sign of breadth for the bulls here today. Really, in terms of weakness, we had energy that seems to be consistently weak down here. And of course, most of you are aware, energy has been this year's leader by far and away. It hasn't even been particularly close. And so they probably deserve a day or two off here or there, considering they've been pulling their weight more than you could possibly have asked for them ahead of time. But in addition to energy, you probably had a little weakness there in utilities, which had also been doing pretty well this year. You have a little bit of weakness there in some of your consumer staples, and then you have a little bit of weakness in some of the pharma and drug stocks. You do have some weakness up there with some of those big telecom companies as well. Now, when you think about those types of areas, oil, utilities, staples, healthcare, telecom, generally speaking, those are perceived to be more defensive areas of the market. So when you have a big, robust bull market type of a move like we saw today, or bullish type of a move would be a better way to describe that, it's actually not that bad of a thing when the defensive areas, or the areas that had been doing well while the stock market was doing poorly, are underperforming today, right? It's okay that the consumer staples are sitting this one out. It's okay that the utilities didn't really support you today. What we want to see is all those companies and all those sectors that got absolutely blitzed in the last several months stabilize. And today was a day where that did occur to a degree. Whether it continues or not is anybody's guess, which is why we try to look at this information each day and try to report on it to you. But what we can say is that today was a win for the bulls. It was a healthy advance, and it was broad-based, and we're happy to see it. The volume wasn't great. That has been the case more times than not here recently. But remember, that's oftentimes the case. When you're looking at extreme moves in the market, volume is often heavier when the extreme move is to the downside. If there's an extreme move to the upside, volume traditionally isn't quite as aggressive. When you do see it, it's a great sign, but it's not necessarily something that you expect out of the market at the same time. You will see here that we have a lot of bright green on our screen. The one that stands out to me immediately, and hopefully stands out to you guys as well, is Nvidia. It was up 7% today, and it's up about 30 straight dollars per share since I did that bullish options trade for you guys exactly 1 week ago. So in just 1 week, Nvidia is up $30 per share. Let's hope it can continue, and so that way we can continue to benefit with our bullish options trade there. So happy to see that one lighting up the screen here today. We also had some assistance there from Adobe, up 5%, Salesforce.com up 7%, ServiceNow was up 6%, AMD was up 7%, even PayPal got into the flow of things, which had been a stock that's been down and out for quite some time. It was up 7% today. Netflix, we all know about their struggles in recent months. They were up 6% today, perhaps on the success of Stranger Things 4, for those of you that might watch that program there. We had Facebook have a pretty nice day, up 5%. Some of you might have seen my tweet yesterday on that. They are officially changing their ticker symbol, I think in about a week, as a matter of fact, and it will be changed to Meta as opposed to FB. I had a feeling and a suspicion that was going to happen for the last several months because Meta used to be a ticker symbol owned by the Metaverse ETF, and then all of a sudden, randomly, they swapped it out for something like MVRS or something like that, and I could tell that behind the scenes what was happening was Facebook was basically asking them, can we have your ticker symbol? And it looks like they must have worked out a deal. So the old FB will be going away here very soon, and it will be replaced with META. Google had a good day as well, up 3%, Amazon up 3%, Tesla up 4%, even Apple up 1%, and Microsoft, while this doesn't look all that impressive with Microsoft only up 0.79%, those of you that followed the market action here today will know that this could be perceived as a major win, and the reason for that is Microsoft actually was the reason that the stock market was down pre-market. Microsoft, about an hour or so before the market opened, came out and told the market that it was expecting a hit on its earnings as a result of foreign currency headwinds. And so Microsoft was actually down like somewhere between 2 and 4% before the market opened. So for them to make up all those losses and then tack on an additional 1% during the normal session was rather impressive. In fact, it was somewhat reminiscent of why we did the Nvidia trade that I explained to you guys 1 week ago. Remember, that was the same day that Nvidia reported their earnings. They were down tremendously pre-market and then came all the way back and then ended up setting up that bullish near-term divergence signal there for us as well. So Microsoft definitely was a big reason behind today's rally, even though it might not be all that obvious by just looking at the end results right there. So as you can see, all in all, a fantastic day here for the bulls. It was a good, healthy, risk-on type of a day. Let's go ahead and pop on over here to the main part of the platform now. And you will see that as we pull up the S&P 500 on the index watch, that 433 out of the S&P 500 stocks were up today. So that's good for about an 87% hit rate. Pretty strong there, with only about 13% of stocks in the market closing lower today. Remember those ones that I rattled off, like staples, energy, utilities. From a components perspective, those are some of the smallest sectors that are out there. Financials are much bigger than them, as an example. Technology is much bigger than them. So that's another reason why we don't have to be all that disappointed with those that did close in the red today. They didn't have a huge impact on the overall market because they come from very small sectors, and their market caps in many cases are pretty small as well. So all in all, as you can see, the foot soldiers certainly advanced today, with 87% of stocks in the S&P 500 closing in the green. Let's also pop on over here to this chart 6D. Now, before we get started with today's analysis, I do want to apologize for what I said in Tuesday's video. Some of you caught this, and I should have caught it as well. I'm a little embarrassed that I didn't, quite frankly. And sometimes we joke that you need to analyze with your eyes, not what your gut or your brain is telling you. Well, that was one case where I wish my brain were clicking at that moment in time, because it was an obvious oversight of mine. And again, I apologize hugely. And here's the reason for it. Not that I'm trying to come up with excuses, but in case you're curious. On Tuesday, which was the last day of June, I pulled up this chart and I pulled up the 20-year monthly chart. So when you look up in the left here, you can kind of see the aggregation period. You can also see it right here above the chart off to the right where it says MO, that stands for month. So basically I changed to make sure that all of these bars are for a month. And when I looked at this with you guys, of course, that's the beauty of doing this on the spot, is sometimes you get a chance to put some egg on your face and get a chance to wipe that off. Not my most fun experience, I can assure you, but nonetheless, it does happen occasionally. We are all human. But anyway, when I pulled that up on Tuesday and looked at what I thought was the month of May, I saw this big red candle down here because that was the most recent one. You can also see there's this green candle off to the right here. That represents the month of June. What I didn't realize in real time was that the month of May was effectively hidden, and this red bar represented April, not May. And hopefully you guys can see what I mean by that. If you were to look today, it's a little bit more obvious because you can kind of see like there's a gap between this candle representing June and this candle representing April. But if I take my mouse away from that, notice how there's nothing in between those two candles, or at least that's what I assumed. The truth of the matter is, the month of May was about as flat as a board as you can possibly imagine, to the point where you can't even see the bar. That is how flat it was. Because remember how this works. It basically goes up when we have an up move over, a month, a week, a day, or what have you, and shows those green bars above the black line, and then it shows the red bars how far you go below it. So it just so happened that the month of May's candle up above looks like this. Many of you will recognize that candle as a bit of a doji type of a candle. In other words, you ended the month almost exactly to the penny where you started the month. And when that happens, there's basically no movement from the front of the month to the end of the month. So you basically have a gap sitting here. Technically, there is a tiny itsy bitsy little peg there. You just can't see it when when I hover my mouse over it. I can barely see there's a little green right there. But if I don't have my mouse over it, I literally cannot see that there is a green peg right there. All I see is the black bar. And so that was where my oversight came on the video there on Tuesday. I literally couldn't see it. So it wasn't that I was trying to give you wrong information or anything like that. It's just that my eyes deceived me and I could not see that there was actually a bar because that black line covered it all up. So last month, the market was actually up by less than, I think it was half of 1%. So not even 1%, half of 1%. And normally in an entire month's worth of time, you get a lot more movement in one direction or another, right? Most of these bars you can see here move well past a 3% move on the up times and well below 3%, minus 3% moves on the down time. So last month was a very strange month in that we basically closed exactly where we opened. So I do apologize if that was confusing to you. I did not want it to be confusing. It just simply was my eyes could not see that little bar there. And I kind of had to laugh at myself when I figured that out as well after the fact. Because a lot of times, in my commentary to you guys, I say, well, let me read this aloud to you because I know some of you are looking at this on a cell phone. I'm literally looking at this on a massive, desktop computer monitor right now, and I couldn't even see that. So I can only imagine those of you that are watching this on a cell phone right now or a smartphone are probably understanding where I'm coming from that. So anyway, that's my apology to you. I will try to do better for you next time around. So thank you for being patient with me around that. So where we stand right now, just 2 days into the month of June, you can actually see a physical green bar there, way more than what we saw in May. So we've already, in just 2 days in June, advanced tremendously more than we advanced during the entire month of May. So I suppose that's the good sign at this moment in time. So with that embarrassing wipe the egg off my face moment out of the way, let's now get to the 1 day movement that I usually show you on this. And maybe that's what, a lesson for me as well. I try to be like the cool guy and show you the monthly chart, do something different for you on Tuesday, when normally I show you the daily, and you can see once I'm out of my element, things go awry apparently. So back to the normal 1 day move, right? This is a 1 year chart that we're looking at now. 1 day. You can also see the D up here has replaced the MO, meaning that each one of these bars represents 1 day in time. And you can see that today was a very impressive day for the bulls. This green bar stretching well beyond this blue horizontal line, telling us that today's move was well past a 1% move. In fact, we nearly stretched up here to the orange line, or a 2% move. So a very, very impressive day, and you can see how that kind of stacks up versus other days that we've had lately. The theme that I had been sharing with you does continue to be the case, which is we have a lot more exaggerated bars here in recent weeks and months compared to where we were a year ago, when things were rather modest, when it was somewhat rare for us to stretch beyond even a 1% move. These days, it seems like we're not just getting up above the blue lines like we saw occasionally a year ago. We're now more regularly getting above the orange lines and also going down below the orange lines down below. So we've kind of stepped up the volatility by, a tremendous amount, nearly, 50 to 100% more, I guess is one way you can kind of think about that in broad terms there. You will notice that with today's major advance on the markets, no surprise, the VIX did fall today. So the VIX lowered itself and ended at about 25 here today. Remember, 30 was somewhat considered a larger VIX, but we never did get to the 40 VIX that we were kind of hoping for some sort of major capitulation type of an event. We did get our long lower shadows, so I did discuss that on Twitter and here as well with you guys in these various classes that I teach, but we never did get a spike in the VIX. So that's just kind of leaving us left, wondering, is that still yet to come? Or is this going to be a move where we don't need that absolute flush out from the VIX? My own mindset around that right now is, if we continue this advance upwards in the market, I will have a higher expectation that we are not done with this overall move yet. In other words, I am still expecting at this moment in time that we will have a prolonged bear market of some sort, either later this year or at some point next year. But I am hopeful that we've at least planted those seeds of growth here in the short term, where maybe we can get back up to some of these levels. I'm still not expecting that we're necessarily going to get back to an all-time high. I think we'll struggle to get back there, but it is possible we could grind our way higher for, the next few weeks or so, right? The hope is that we have a somewhat bullish market into the June options expiration period, which will happen here in a couple of weeks. Remember, I discussed that notion with you guys exactly 1 week ago. That was part of the reason that on that Nvidia trade, I took the June contracts as opposed to the Julys, because my expectation is that we'll have bullishness into the June expiration period, but I'm not quite as confident with my expectations that we'll still be that bullish in July. I hope so, but my expectation, my confidence around that is just not quite as strong. So we kind of have to take it day by day, so to speak. But you can see a very impressive day here for the market. You had a bit of a bullish engulfing candle, it appears, from today's body versus yesterday's body. In fact, you probably engulfed the prior day's body as well. Not only that, but we basically closed at the high of the session here today as well, which always gives you that impression that had the stock market been open longer, we probably would have gone up even further. It was only the bell that saved the bears here today. And so that's a positive sign there as well. Notice that we've had several of those types of candles here in the last week and a half or so, where these open candles are closing near the highs of their day, and that's a positive sign. It basically means that the bulls are not willing to roll over the way that they were when they were closing at the lows of the session regularly back here during this downdraft that we had in April. So anyway, kind of interesting. Let's go ahead and take a look here at our normal 4-grid now. And as I pull this up, you can see that we have some positive vibrations feeling its way through the market at this moment in time. you will see that all of these indices were up today. In fact, all up handsomely. The S&P 500 was up 1.84% today. The Dow Jones was the day's laggard at an increase of 1.33%. Remember, that happens often. The blue chip index usually lags the other more speculative areas on a big up day. So that is kind of following through with that general playbook. You do see that the NASDAQ composite, which is chocked full of the most speculative types of stocks out there, a lot of those growth and innovative types of companies that have been bludgeoned in recent months, those are the ones that are snapping back the most aggressively at this moment. They led the market here today up 2.69%. So all of those big companies like Nvidia and PayPal that I had mentioned before, and Netflix, right? A lot of those companies had been in severe downtrends, and now all of a sudden they look like they want to be a leadership stock, at least in the short term. And then you had the Russell 2000, of course, the small caps here in the United States, which, by the way, will have its annual rebalancing coming up later this month of June. Russell 2000 was up 2.31% here today. So that was another big move and outperformed the large cap blue chip indices up above. So great moves. And not only that, when you look at all four of the candles associated with those charts here today, notice the same thing holds true. It's not just the S&P 500 where we effectively closed on the highs. We basically closed on the highs across the board. And so that's a really good sign there. Again, this was a day that was being led higher by the foot soldiers and the generals, and the market couldn't get enough of them. They wanted to bid them up even further. And the market's actually up just a little bit in the after-hours session tonight. There were a few companies reporting earnings and what have you, but we'll see how that shakes out first thing tomorrow morning. But hopefully that means that the momentum is pushing forward. Now, there is a potential wrench in those plans in that tomorrow represents the first Friday of the month. Most of you are aware that the first Friday of the month brings one of the most important economic releases of the month as well, which is the jobs report. And so depending upon how the market interprets that, there is some potential for some volatility after that tomorrow as well. So we'll keep our eye on that story as well. But with today's big moves, you'll notice that all four of these charts are now trading above their 30-day moving averages. Remember, when I was with you on Tuesday, that was not yet the case on the NASDAQ composite. So that is new information today on the NASDAQ. Even yesterday, it closed below that falling moving average. Remember, you can use the color coding of the 30-day moving average itself to help spot that a little bit closer. We see this moving average turn from red to yellow today. It basically means, in this case, price is now above a falling moving average. Notice that these other charts, the S&P 500 was a little goofy because it kind of went back and forth, but we've had consistent yellow here on the Dow Jones, and we've had consistent yellow here on the Russell 2000 for the last 4 trading sessions. So those have been a little bit more bullish in kind of that general, 5-day window or what have you. But it is good to see NASDAQ playing catch up because they were a little bit of a laggard. And again, they had been beaten up much worse. And so they have more aggressive moves to the upside to make up for. And they've done a pretty good job catching up there. So it's a good sign. We have weekly bullish postures. That's what that light green background color is telling us on all 4 of those charts. All 4 of them closed at the highs of the day. All 4 of them had, strong closes. So we closed at the high of the day, which, I was just about to say that we had an extended range day as well, but that actually wasn't the case across the board. Notice that one of these ranges, the Russell 2000, was slightly less than its average true range. So with the exception of the Russell 2000, the other charts also had a very aggressive and extreme trading from high to low today. Remember, you see that a little bit more often on the sell-off days, so it is maybe a little bit more impactful when you see it on a big up day. And again, a big part of that reason behind my mindset there as far as why that happened was Microsoft. Remember, Microsoft is a component of the S&P 500, of the Dow Jones Industrial Average, and of the NASDAQ Composite. So it kind of blends all 3 of those, whereas it is not part of the Russell 2000. So Microsoft started us off on a bit of a sour note to start the morning, but then came rallying back all day long and kind of just lit a fire under that whole technology sector. So kind of interesting to see that these daily range labels are orange on those other three indices there as well. So price is above a falling moving average in all four of these cases. We have weekly bullish intermediate postures according to the market forecast technical indicator on all four of these, and basically all four of them closed at their highs here today with basically an 87% hit rate underneath the surface. A very bullish day across the board. Now the goal is, let's see if we can hold these levels above the moving average, because there has been times in the past where you just haven't been able to hold them. You can see back here we had a little bit of that color change as well on the on the Russell 2000. It wasn't able to hold it. Looks like we're having a better opportunity to hold it this time, right? Because we've already spent a few more days above that moving average. So it's looking a little bit more promising here all of a sudden. And it's just a matter of, where do we go from here, and whether we can actually have a trend-changing reversal. And that's where I still personally have my hesitations. And again, I hope I'm wrong, because I can assure you my portfolios would appreciate it much more if I am wrong. But my hesitation still leads me to believe that we just have not suffered enough pain yet in this market. And we are probably due for a reprieve after, we had those 7 weeks in a row of selling. We deserve this rally that we're getting right now. But at the same token, we probably don't deserve to go back to all-time highs. So we're kind of playing in the middle grounds here, perhaps for the next few months, and doing our best to spot opportunities on a one-off basis with individual stocks underneath the surface. All right, let's go ahead and step away, pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support us with these free videos that you are listening to here on YouTube. And I had a call to action for you guys, so to speak, a couple of days ago, and you didn't disappoint. You came through strong, just like I knew you would. And we went from having like 87 likes or whatever it was a week ago when I did that Nvidia trade, which I thought was a pretty good trade. Maybe some of you disagree with that, but $30 to the upside in a week is pretty good. So I was a little bit surprised that I got way less than 100 likes on that particular video. Well, you guys stepped up. Maybe a lot of you were just busy on the Memorial Day weekend or what have you, but this time around you didn't disappoint. 119 of you clicked like, which is why I'm doing the full-length video for you right now and not just a quick little 15-minute hitter video like I did for you on Tuesday. So one other thing I wanted to point out here, because I got a question about this, that sometimes there's some confusion around how do you actually go about this process. There are actually 4 different ways you can click like for us on Twitter. And sometimes we don't always have the opportunity to talk about that in detail because we just have other things to discuss. But since I got a question on it, let's use this as one of the rare opportunities where I can show you in case you don't know about some of these different ways. So there's 4 different ways that you can click like for us on Twitter. And each one of the ways is a little bit different, but they all will add to the Twitter like tally. So if we're trying to get up and over 100 likes, any one of these 4 different ways that I'm about to show you will help us accomplish that goal. Now, if you're watching this video on our website, so over here at marketscholars.com, a lot of you come up here to our, Market Outlook tab and then just watch these videos directly on our website. So you'll notice that if you clicked play right here on the embedded, video player, you can listen to David and I doing these videos. Well, directly below that embedded video player, there's a couple different widgets. There's a Twitter widget, which you can identify with a little Twitter bird there in the corner, and then there's a Facebook widget, which you can see with a Facebook thumbs up right there. I hardly am ever on Facebook, if I'm being honest with you, and I'm hardly ever on LinkedIn or StockTwits. Even on YouTube, I'm not really on those other than to post the videos, but I'm not actually looking at posts or anything along those lines. So where I am at is on Twitter, which is why I pay particular attention to our traction with these videos on Twitter to judge whether we are having success or not. Because I'm on Twitter pretty much all day long discussing various trading opportunities, trade setups, sharing cartoons with you, having a little bit of fun, sharing some family photos, all that kind of stuff. I do that on Twitter. I don't do that on all the other social media stuff. So that's where I'm a little bit more in tune to whether we're having success there or not. So if you are watching this video on our website and you want to click like for us on Twitter, just come down below the video and look at this widget each day that you're watching the video. And if you click this like button, so I'm not talking about this like button down here, that's associated with our website. I'm talking about the like button directly on the widget that has the little Twitter bird on it. If you click that, you'll notice that it will take you to this actual tweet in question, where you can then click like if you want to. It says now you can click that or you can now like that tweet. So I'm assuming you click like there. I'm not going to do it because it's my tweet, but that's what you would do if you so desired. So that's one way you can go about that process out of 4. The second way that you can go about that process is for those of you that are like me that are on Twitter a lot, the easiest thing for you to do is probably just go to David and I's profile on Twitter itself and click like. We try to post those market outlook videos as the pinned tweet that we have. A pinned tweet basically means Twitter allows each of us, yourself included, to pin one tweet of yours up at the top to make it easier for other people to find it. And that way they don't have to go rifling through, all of your other tweets that you had during the day. So we try to make that easier for you by pinning the most recent market outlook video that we did at the top of our timeline. So if you just go to twitter.com/Brandon Van Z, you will find the most recent market outlook video pinned to the top of my timeline. Same thing goes for David. And we just swap those out every time that we do a new video. So that would be another way to get to that specific tweet. And you can see there's 119 of you there. That matches exactly what I showed you on our website a second ago, because those two things are in alignment with one another. And again, you do the same thing. Just click the heart button underneath the tweet in question right there. So that's the second way to go about it. And by the way, you can search for this stuff too. You could probably do a search on Twitter and do market outlook, so hashtag market outlook. And you'll probably find that a lot of David and I's posts will be up there because we always include that hashtag market outlook to make it easier for you guys to find. Another thing that I just thought of that would be easy for some of you as well, because maybe some of you don't like to read all of David and I's other tweets. So another thing that would be easy for you if you wanted to help support this by clicking like for us on Twitter is just go to our corporate handle @Market Scholars. So twitter.com/Market Scholars, all one word. And here, we always retweet this as well. So here was David's, market outlook video from yesterday. And you guys did a good job helping him out with 105 likes there as well. And if you keep scrolling, you'd have found mine from the previous day. So this doesn't include all the personal stuff. It's only going to include the corporate stuff. So this would maybe be a more efficient way for you guys to find those market outlook related tweets if you so desire and if you want to help us out. So anyway, directly on Twitter is number 2 of 4 different ways where you could help us with that. The third way that you could help us is for those of you that watched our videos directly on YouTube. So here I am at youtube.com or however you access YouTube. And under YouTube videos, they allow you to edit a description area. Now, this isn't quite as obvious as it used to be because it even threw me for a little bit of a loop. I think in the past it actually used to say description down below. But right now it's a little bit goofy, and you can see directly under our title, so this is just a previous video that I had done to show you as an example, it shows you the views and different things like that, but there's this little area here where you see like a hyperlink and it says more. So again, it's not quite as obvious as it used to be. It used to say actually description, but if you click that more right there, it will serve as that old description area where you will see our tweet, our Facebook post, our LinkedIn post, our StockTwits post, how you can follow us, how you can join our community on Facebook, and like I always say in the beginning of all of my videos, this is also where you go to subscribe to our email distribution list. All of that is in the description area directly below the video that you're watching on YouTube itself, or if you're watching it on the app, the YouTube app, or what have you. But the point is, we swap these links out every single time we do the video. So if you were to come down here and you wanted to support us by clicking like on Twitter. It says right here, like and retweet today's video on Twitter. And if you click that hyperlink right there, it will take you to that tweet in question. And you can then like it at that point. So this is the one that I did a week ago that still only has 88 likes, right? So again, that's the one that we didn't quite get to our 100 goal. But that's another way for those of you that don't want to go to our website, don't want to go directly to Twitter, but you are watching these videos regularly on YouTube. We try to make it easy for you to, just take the 5 seconds, click the link in question there in the description area, which allows you to then quickly click like there as well, because we're trying to make this as easy as possible for you guys, right? We don't want it to make it seem like it's a big hassle for you. We're trying to make it real easy where it literally takes you less than 5 to 10 seconds type of a thing. So that's the third out of the 4 different ways where you could get to the tweet in question. And then the fourth way is for those of you that are on our email distribution list. I'm going to show you an example of an email. So normally when we send out our emails to you, this is approximately what it will look like to you. And so you'll look at this and you can kind of see, some of these things you can click on. You can see, the paragraph write-up that we have. And then you can come down below and there's this kind of bar. And David's might look a little bit different because we kind of both do our own individual emails there, but it's going to have approximately the same type of a feel to it. But anyway, notice that there's all these different social media icons at the bottom of those emails. And if you click this one that says Twitter with the little Twitter bird icon on it, it will then also take you to the tweet in question for that particular day's tweet. So that is the fourth way. So way number 1 was on our website itself in the Twitter widget directly below. Way number 2 is for those of you that are already on Twitter, you can just go to our profiles and our timelines and our Twitter feeds, and at the top will be pinned the most recent market outlook video in question that we want you to like. And then number 3 is for those of you that watch directly on YouTube. If you go into the description area, you'll find a link to that direct tweet. And then way number 4 is for those of you that are signed up for our email distribution list, click the little Twitter icon at the bottom, which will take you to that tweet, and then you just click like once you get there. So wanted to take a moment since I had some questions about that, and it's not maybe always abundantly obvious how you go about that process. So thank you to all 119 of you that did that for me last time around. That has unlocked the opportunity to have a longer form video again. So keep that up. Try to train yourself to do that every single day. It'll go a long way for David and I to justify the amount of time that we need to take looking for trade ideas and looking for different ways to market our business, looking for different ways to educate you guys. It all makes a difference. So thank you very much for your help in that endeavor, for your ability to watch these videos completely for free. All right, let's get over here on the sector selector, since we didn't get a chance to look at this in Tuesday's limited video. Now that we've got a little bit more time here tonight, let's take a gander at it. Now keep in mind this is from last Friday night. So tomorrow night I will have a new update on our website for this as well. But this will give us a basic idea as to any trends that we might be seeing taking place here. And we didn't really have a lot to discuss week over week. What I would say is we had a pretty nice move in financials. The week prior, financials were second to last. We popped all the way up to number 7 here in this most recent ranking. And so, some of you have been seeing me tweeting about JP Morgan and BlackRock and a handful of those dividend growth stocks that are in that financial sector, and how they had gotten to be in extreme oversold conditions. Well, that has now started to unwind. JP Morgan and BlackRock and some of those are bouncing out of those blue zones on the dividend stair-step chart, and I think that's helping support financials at large. But otherwise, we had a lot of the same exact rankings week over week. So we'll see if this week might end up being different when I put this together for you guys tomorrow night. Also, while we're over here, just a heads up that I did teach my question and answer session here today. It was another 3.5 hour extravaganza. The first question of the day was an interpretation of the new sector average high yield numbers on Twitter. And what that is referencing is, let me come back here real quick and show you in case you might have missed it along the way. some of these numbers that I posted to Twitter here yesterday, talking about the overvalued area and the undervalued area using the dividend stair-step chart and how you can kind of interpret that by sector. And by the way, Greg, if you're out there listening, you did a great job as well. I like your idea of including those all in one line, and I appreciate the example that you showed there. I may very well try to do that in future months if you guys get value out of this information. It looks like 81 of you clicked like for me there, so it appears that this is something that you guys do like and you want more of in the future. So I do take note of that, and obviously the more successful our tweets are, the more we are encouraged to do more of those types of tweets in the future. So anyway, during today's question and answer session for my premium members, I did spend about an hour from the 12-minute mark to the 1 hour and 7-minute mark interpreting that analysis of the sector's attractiveness from a dividend growth investor's perspective versus unattractiveness at this moment in time. So feel free to check out that answer on the recording. I also got a question about Medtronic as a dividend growth investing company and some of my personal history with that very stock over the years as a dividend aristocrat. I also got a question about UGI, one of the utility stocks that we bought at the end of March in my dividend growth investing class. And that stock is up about 22% for us since we bought it. So we took a fresh look at it here today, despite it having grown pretty nicely over the last few months. Also got a question about how to interpret stock splits like Google and Amazon that are coming up. I also got a question about explaining my tweets on Intel when I was talking about how Intel on May 20th had an oversold cluster signal, and I was tweeting about that, how rare that was. It was only the second time in the last 15 years or whatever it was that occurred. And by the end of May, because we got a big rally at the end of May from the broad markets, including Intel, it did not close with an oversold cluster signal. So although on an intra-month basis we had an oversold cluster signal, it did not actually close that way. So people throughout history will not actually remember that Intel had a monthly cluster on May 20th because it didn't close that way. But those of you that follow me on Twitter do know that was vastly oversold on May 20th, and it would have been a fantastic day to be buying Intel shares where you're up probably about 8% or thereabouts in just about 12 days since that tweet. Also got a question about the differences between the dividend yield and the yield column headers on the Thinkorswim platform and why those numbers come up a little bit differently from one another. And then I got a question about what the yield range is of my dividend growth investing portfolio, and a continuing conversation about how to calculate yield on cost and how to think about that as a long-term investor, and how that is a lot different than what current yield will bring to your attention, and is an opportunity for folks to kind of stay in their seat, so to speak, right? Buy right and sit tight is kind of the idea for those of you that want to watch your yield on cost grow throughout the years. So some great stuff there for you to sink your teeth into. David did teach his portfolio management with ETFs class earlier today as well, so make sure you check out that recording as well. And then tomorrow, David will be teaching his popular technical analysis class. So for those of you that have ever wanted to be taught by a chartered market technician, tomorrow is your opportunity, as is the case on most Fridays, directly from one of the best in the business there, Mr. David Settle himself. So should be another great class that he has in store there for you. Let's get back on track with the Thinkorswim platform now, and let's do some 12 grid analysis since we didn't get a chance to cover those in Tuesday's limited video. So let's start off with the asset class 12 grid. This here is the the way to kind of gauge what's going on with lots of different financial assets across the board. So it's not just stock exclusive. And so on this particular 12 grid, the assumption every time I pull it up should be that there will be a mix of green and pink charts. Now, one of those should be blatantly obvious why that's the case, because I have both long-term U.S. Treasuries themselves on here, and I also have the 10-year U.S. Treasury yield. And remember, yield moves opposite from price. So at a very minimum, the vast majority of times I bring up this 12 grid, this chart on TNX should have an opposite color of this chart on TLT. Every so often that doesn't happen, but I would say probably 90% of the time that is the expectation. So this is a first set of 12 grids here that we don't ever really expect a clean sweep of nothing but green charts or a clean sweep of nothing but red charts. It is one that allows us to learn where there is strength across multiple asset classes out there. So let's get into the analysis here. You can see we have a pretty healthy mix between green and red charts at this moment in time. For those of you that are newer, remember the red charts represent stocks that have bearish intermediate postures according to the market forecast technical indicator, and the green charts are those that have bullish postures. So when we're looking at this, you can see there are 4 pink charts on the board: TLT, BNDX, which represents foreign bonds, Bitcoin, and then the US dollar. And so as we look at those 4 charts, I would say that the one that looks different than the other 3 is the US dollar. The US dollar down below had been in a significant uptrend to the point where it actually got some very rare for it overbought cluster signals. That's what these little red dots signify here. And once we got those overbought cluster signals, that was basically the market's sign to change the trend, or at least attempt a change of the trend. A lot of times you get just a little bit of a breather type of a move, right? Like kind of like a reversion to the mean type of a move. And that could still be the case here. But for those that are hoping for a legitimate trend reversal itself in the US dollar, there is actually evidence that that could end up being the case here as well. You will see that not only did we revert back to the mean, to the moving average, but we crashed below the moving average, and we've spent the last week plus below the moving average on the US dollar. That's a 30-day moving average there. Now the moving average is still rising, which is why it's yellow at this moment in time, but the longer this stays down below the moving average, the greater the likelihood is that this moving average will eventually start rolling over as well, and then it could very well start being used as resistance and an excuse for folks to push the dollar lower. So let's keep our eyes on that possibility, because that's a little bit of a difference compared to the way that we were thinking about the markets broadly speaking just 3 weeks ago when the dollar was strong. Right? A whole different group of stocks can excel when the dollar is weak compared to when it's rolling higher like it had been previously. One of the areas that tends to benefit nicely when the US dollar is weak, at least on a relative basis, are the foreign assets. So notice up above, EFA was up 2.08%. It outperformed the S&P 500. That's your developed foreign stocks. Think about Europe, Australia, Japan, and what have you. You'll also notice that EEM had a good day. It was up 1.72%, but it just barely did not beat the S&P 500's 1.9% advance. However, staying with the theme of what I'd mentioned before, all else being equal, when the US dollar is weak, foreign assets strengthen on a relative basis versus their respective US assets. You will notice that as we look at these 3 charts up above here, only one of them has the light green background color, and that is the US S&P 500. EFA for the developed foreign stocks and EEM for the emerging foreign stocks both have that dark green background color, telling us that their posture is considered strongly bullish, not weakly bullish like we saw over here. I'm not particularly enthusiastic about any of the 3 charts, but as I always say, if you are going to get a reversal, it's got to start somewhere, and it's always going to look ugly in the beginning. So you don't want to necessarily discount it at the same time, and you have to respect the fact that, hey, there's been enough of a bounce off of these lows where we had all these oversold cluster signals. It's been aggressive enough to actually change the market forecast posture to strongly bullish, not just weakly bullish. So the foreign assets are starting to take a little bit more of a leadership role now that we are seeing a weakening US dollar. A lot of times what we see when the dollar gets weak is that commodities also tend to do better. Right now we've got a little bit of a mixed bag around that concept. Remember, none of this is ever happening in a vacuum because there's always other things that can affect it. So we have to keep that in the back of our mind as well. But as you see here, oil, of course, continues to go up at a very healthy pace. And that's been the story for much of 2022. So this is not some sort of a new light bulb that should be going off for you. If you've been watching David and I's video, you absolutely have known that oil has been hot for a long period of time, and that has not changed. What is a little bit different about this is that gold does not look particularly good. Gold had really broken down below its moving average and now is struggling pretty much on the underside of its 30-day moving average, which brings up that possibility that you do have resistance in that area. The good news is that gold did revert back to a weekly bullish posture. Remember, that was not the case in recent weeks where it had a bearish posture. So at least it's kind of rebounded enough to get back one of those posture levels, but we still got work to do there. This is still a pretty ugly looking downtrending 30-day moving average, whereas oil just continues to work for those that have placed their trust in that area. We talked on this candle about how despite it coming below the moving average, I wouldn't give up on it quite yet. And it's a good thing that I made that comment because you can see that was the absolute low in that move, and we've gone pretty much straight up since that move. And the reason I mentioned that to you guys on that day was because of all of these other times where it looked the same way. Every time it looks like oil is going to roll over, they just simply do not do that. Instead, strength pushes into that particular area. As I mentioned earlier in the year, oil and oil stocks are criminally underowned. And I think we are finding that out as the year goes along because a lot of institutions and hedge funds still have a limited exposure to that area despite it being one of the strongest areas and one of the only areas with good alpha or positive returns here this year. But anyway, we'll see if gold can play a little bit of catch up. If the dollar remains weak, the chances of that are higher than not. If the dollar catches a bounce here, then the opposite could absolutely occur, and gold could use that as an excuse to then continue into its downward trend that we find ourselves in at this moment in time. High yield bonds also look pretty good. That was a comment that I made to you a week or so ago as well. It was that day where high yield bonds were up tremendously, and we didn't really see that out of the other bond categories. And I was saying how that is a good risk-on sign for the markets at large, because if the markets were concerned about corporate defaults, that should not be happening. So that's another thing that says that, hey, this market pop that we've had here in the last week or so is a little bit more legit because you're seeing the confirmation of that through the bond investors' eyes as well. Money is moving out of the so-called boring government bonds into the stock market, and it's also supporting the junkiest of corporate bonds out there. And if there was concerns about defaults and bankruptcies and all that kind of stuff, you likely would not be seeing this type of behavior out of HYG, the high-yield junk bond market. So I think that's another positive sign or feather in the hat of the bulls at this moment in time as well. Let's now drift our attention on over here to the U.S. sectors 12 grid. Now here, to make the comparison to the first one, that is the asset class 12 grid, remember in this second 12 grid here for U.S. sectors, these are all stocks, right? This is not a mix of cryptocurrencies and bond prices versus bond yields versus commodities versus foreign stocks and preferred stocks and all that kind of stuff. That's like kind of a mixed bag in that first group. This is more of a correlated basket of entities because these are all stocks in the S&P 500, and we do have a clean sweep at this moment in time. Not only does the S&P 500 have a weekly bullish posture, but every one of the 11 sectors that represent the S&P 500 also have bullish postures. Now, the strongest bullish postures are those that have this dark green background color. So that's one way to kind of distinguish things. And as I mentioned before, energy, of course, continues to be the king. They were down today. They were the only sector that was down today, as a matter of fact. They were down 0.32%. But when you look at this chart, it is still the strongest chart out of all of these on the board. It is the most persistent trend. So do they deserve a day off where they go down by less than 1%? Of course they do. They've gone up most of the days of this year when most of the rest of the market has struggled. So not a huge surprise there. These other charts I don't think look as good as energy, but the fact that they've turned to strongly bullish is somewhat noteworthy, and we want to make sure that we respect that because we don't know when there will actually be trend changes that take place. Of those three other dark green charts, I would say that utilities and materials maybe look a little bit better to me than what we are seeing there with technology. And I suppose if we just read the label, that actually confirms that thought that I just had as well, because the intermediate line on technology is at 52. The intermediate line on materials is at 55, and the intermediate line on utilities is at 65. So these other two do have more strength from that perspective than technology does as well. But of those three, it appears to my eye that utilities is the closest to getting back to multi-month highs. Now remember, utilities does tend to move slower than materials and technology, so that can certainly change in coming weeks, but they have, let's say, the easiest job to get back to their highs and kind of join energy in that pursuit. All of the rest of the charts are that light green background color telling us that we have weekly bullish posture. So it's a start, but we still have a lot of work to do before we get really ambitiously bullish about this market. In terms of today's biggest winner, we did have consumer discretionary being up 3% here today. So that was a nice big move there out of the discretionary area with, Netflix and with Tesla doing quite well, as I alluded to during the heat map section of tonight's video. All right, let's get into our trade application example now. And for it, I'm going to pull up chart 3A. This is just our normal swing trading one grid here. And I'm going to pull up ticker symbol eBay. And of course, the ticker symbol also represents the name of the company, so that one's a little bit easier for you guys. Sometimes you might not always know the ticker symbols of the names that we're talking about, but in this one, it's a pretty easy one. eBay represents eBay. And what I did, and remember, I've already done the trade. We do the trades while the market is open, so that way we can telegram out the information and give you the trade alerts if you are a premium member of Market Scholars as a perk, right? Everybody else that's just watching the free video on YouTube at night that's not a member of Market Scholars doesn't get to learn that information until after the market is closed. And I will be upfront with you guys on today's trade application example as well, where this was not my first choice. So some of you saw that I got this trade application or this trade alert out pretty late today. Normally I want to get the trade done a little bit earlier than I was able to send it out today. But the problem is I was actually trying to get filled on two separate trades before I ultimately got filled on eBay. And one of them was an iron condor on an individual stock, and the spreads were pretty wide, and I just could not get filled at my limit price that I was trying to get filled at. And then the second one, I was trying to short sell a different company, but on paper money, it was the hard to borrow status, so the platform didn't let me do a short sale on it, even though it was a large cap company that I'm sure was available to short on a real money platform. So I kind of had to opt for this third choice as a last minute scramble to get the trade done, since the other two just weren't working to my advantage. So I will be upfront with you on that to let you know this might not be the best trade idea here, but I had to get something done by the time that the closing bell rang. So we'll see how it works out. But what I did in this case was I sold a bear call spread on eBay. I like to, kind of sprinkle in some bearish trades here or there, so that way I can kind of balance out my portfolio. Remember, out of all of our positions prior to this, let me come over here to the monitor tab real quick. Out of all of our open positions in the market outlook category for my video specifically, remember David has a separate paper money account, but for mine, you can see here that we only, prior to the eBay trade, had two other bearish trades. That was AbbVie with a negative delta, and that was Texas Instruments with a negative delta. All the rest of those are bullish trades. I would also point out that we happen to be at a rare moment in time where every single one of these trades at this moment in time is positive. But like I alluded to on Tuesday, remember this would not include those beer trades that I attempted and was stopped out of. So it's not that I hit them all, but the good news is we've been having more success than lack of success with these free trade ideas that I bring to your attention. Every single one of these is a positive in the PL open category at this moment in time. By the way, the best buy, remember, was a rolling trade, so that doesn't tell the full story there, but is still a winning trade there for us nonetheless. So I am happy with the results that we've had thus far, but I also am cognizant of the fact that most of my trades were bullish trades done when the market was in a downtrend. So now that the market is kind of going back into an uptrend, I'm trying to find unique moments to kind of fade that move to kind of balance out the portfolio a little bit, right? If I was willing to do all those bullish trades when the market looked like junk, and now we're benefiting from that when the market is finally rebounding, I got to kind of think in the opposite terms as well. When the market does rebound, I've got to start sprinkling in some bearish trades here and there in order to balance things out, so that way I'm not too lopsided within my portfolio. So with this eBay situation, what kind of attracted me to it is that this is an underperforming security. So the S&P 500 dotted line up above suggests that this stock is underperforming that over the last 3 months. eBay itself was up 1.7% today, but that underperformed the 1.9% advance of the market at large, so it underperformed on a daily basis there as well. You can see we have a pink background color on this chart telling us that the near-term posture is considered bearish at this moment in time as well. And the strike price that I sold, which is the driver of a bear call spread, was the 50, and I bought the 52.50. It's a little bit tighter than I would have preferred, to be honest with you, but there wasn't a lot of choices because you didn't have dollars between the strikes on this one. But one good thing about that particular level on this chart is if I got out my horizontal price level tool, you can kind of see that at around 50 even, if I could get it close to it, there's 50.02 right there. You can see that back here in the middle of March, that represented a support area for 2 days, and then you got a bounce. And the theory in technical analysis, or one of the theories in technical analysis, is that when that old support level breaks, it can then represent resistance moving forward. So I'm hopeful that by selling that $50 strike, there will be some bears that show up at around that level. And remember, I get a little bit of breathing room there as well because I got 72 cents worth of credit. So technically, my break even, if I were to adjust this exactly where I wanted it to, would be $50.72 to account for the credit that I took in, which gives me 70 more cents of breathing room up there that I might very well end up needing as well. So that was my trade idea for today. If you got value out of that trade idea, or if you got value out of any of my analysis of the 12 grids or the other stuff that we talked about here today, I ask one simple request out of you. Click like there for me on Twitter. I showed you in this very video 4 different ways that you can accomplish that task. So as long as you are willing to put in an effort of 10 seconds, I think you can accomplish that for us. And as long as we're up and over 100 likes, by the time I do the video on Tuesday, I will plan on doing another full-length video with a trade application example at that time. If we're under 100 likes, then I'll do what I did on Tuesday, which is just a 15-minute brief overview of only the indices themselves. So whatever you prefer is what will dictate your actions. If you like the longer form videos, you'll want to figure out a way to click like for us for free on Twitter. If you prefer the kind of honed in, more efficient 15-minute variety, then you have that every opportunity not to click like for us. And we will go with whatever side of 100 it falls on. So thank you for your support. Thank you for checking out the video. I wish you all the best of success with your trades and your investments. Goodbye for now.